down 72% and 83% respectively. Which stock is the better buy, Twilio or UiPath? Let's take a look at a few different metrics to compare these two companies together to determine which one is better for investors in 2023. The first thing I want to compare the two on is year over year quarterly revenue growth, and we don't have much history for UiPath. For Twilio, we have some history going back to 2018. For both, what we see is decelerating revenue growth, UiPath ending at 19% and Twilio ending at 32.8% in its most recent quarter. The interesting thing to note here is that Twilio's management came out and told investors that it's no longer reasonable for them to expect Twilio's revenue to grow 30% per year annualized, and they've exceeded that level for several years now, but now Twilio is saying don't expect that from us going forward, so the expectations have been brought down. That's going to be important. Keep that in mind. The next thing I want to look at is revenue on an absolute basis, not just growth wise, the total revenue. Twilio at 983 million and UiPath is a much smaller company at 267 million in quarterly revenue most recently. I want to use that figure to compare with its operating income, with its net income quarterly, and UiPath lost 57 million in its most recent quarter. It's only been profitable for one maybe two quarters, mildly profitable in its history, and Twilio has never had a profitable quarter in its history, and it lost 482 million in its most recent quarter on revenue of 983 million. So massive losses on the bottom line for Twilio and UiPath as well when we look at, but on a percentage basis, on a proportional basis compared to revenue, Twilio's losses are much larger than UiPath's. The next thing I want to look at is cash flow from operations. And again, I want to compare it to revenue. UiPath lost 27 million in cash flow from operations in its most recent quarter. It had a few quarters of positive free cash flow. If you ask how a company can have positive free cash flow even though it's losing a lot of money on the bottom line, and this is common with tech companies because they pay their employees in a lot of stock-based compensation, which is a non-cash expense, that allows them to be positive cash flow from operations even though they need to record that expense on the income statement, which causes them to be negative on the bottom line. And in this regard, Twilio has had several quarters of positive free cash flow. In fact, for several years, it's operated mostly positive cash flow from operations. Only in the recent several quarters did it really dip into negative territory, losing 115 million in cash flow from operations in its most recent quarter. So overall, just looking at these two companies, their prospects do not look that good. I'm seeing revenue growing, but I'm not seeing economies in scale in terms of profitability or cash flow from operations. I'm seeing as revenue grows, I'm seeing losses worsen. So it's almost like the faster they grow, the more money they lose. When I see businesses like this, I would prefer they get themselves into a more sustainable business model where you can see some evidence of economies in scale developing rather than just trying to grow revenue rapidly. And that's why I'm going to point back to what Twilio's management said. Don't expect us to grow 30% annualized anymore. And I think that was a prudent move by management. I think that was management saying, okay, we need to get on more sustainable growth basis here. We can't keep growing so rapidly and keep adding losses to the bottom line. We need to grow more prudently and demonstrate some cost management, some discipline in choosing which customers they go after and how much growth to go after as to not lose so much money on the bottom line. And I like that. I like that management came out and did that because number one, it's just a more prudent way to manage the business, in my opinion. I prefer to invest in those kinds of companies. I don't like to invest in companies that are just like, let's just grow as fast as we can. Let's go get all the business we can. Who cares how much money we lose on the bottom line? That's not my type of investment. And secondly, what I liked about that is when management came out with that with that announcement, the stock price the stock price fell considerably as expectations fell. So now that expectations are lower, the valuation is lower. That's what we're going to look at on the next slide. You look at their price to sales ratio. UiPath is selling at a price to sales ratio of 6.3. Meanwhile, Twilio is selling at a price to sales of just 2.2. So nearly a third of the valuation of UiPath. So as you've probably taken the my tone of the argument so far, you probably realize that what my answer is going to be, the better buy for 2023 would be Twilio stock, in my opinion. Management is becoming more prudent, investing more carefully in growth and not trying to just grow as fast as possible. And I like that their valuation is cheaper. However, I will say that if you could, I would hold off on buying either of these stocks. Not I wouldn't buy any of these stocks in the first half of 2023. Headwinds are persisting. Enterprises are reducing their spent capital investments. The Federal Reserve is raising interest rates, which is not good for tech stocks. The first quarter is going to be with a lot of risks. I wouldn't buy either of these tech stocks in the first quarter. But if you wanted to buy one of them for 2023 after the first quarter, I would go with Twilio stock here. All right, so that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.